In this lecture, we step into the world of banking and finance, where artificial intelligence is no longer a distant experiment, but a quiet engine powering everyday transactions. From digital lending apps to fraud monitoring at major banks, AI is changing how money moves, how risk is assessed, and how customers are served. If bankers, accountants, and fintech operators in Africa fail to understand this shift, they will become operators of systems they do not truly control. Those who learn to work with AI, however, can design fairer products, protect customers more effectively, and build stronger financial institutions. At the heart of banking is one key question: can this person or business be trusted with money? Traditionally, credit decisions relied on paperwork, collateral, guarantors, and human judgment. AI introduces a new layer: models that learn from data. A credit scoring system can analyze thousands of past loans, examining income patterns, repayment histories, transaction behavior, and even phone usage data where allowed. From these patterns, it estimates how likely a new applicant is to repay. This can open doors for people without formal collateral, especially in the informal sector. But it also raises important questions: which data is used, how accurate it is, whether it contains bias against certain groups, and how to explain the decision to a rejected applicant. Responsible bankers must insist that AI scoring complements, rather than blindly replaces, human judgment and regulatory safeguards. Fraud detection is another area where AI is becoming indispensable. In a world of instant transfers and online payments, criminals move quickly. Rules written by humans alone cannot keep pace with new tricks. AI systems can monitor millions of transactions in real time, spotting unusual patterns: a card suddenly used in a foreign country, repeated failed login attempts, or transfers that deviate from a customer's normal behavior. When such signals appear, the system can flag or block the transaction, request extra verification, or alert a human officer. This protects both customers and institutions. Yet balance is necessary. Too many false alarms frustrate genuine customers. Poorly designed models may unfairly target certain locations or customer segments. Banks and fintechs must continuously review these models' performance, adjust thresholds, and listen to client feedback. Customer service is also being reshaped. Many banks now deploy chatbots and virtual assistants across their apps, websites, and social media channels. These AI systems answer frequently asked questions, help customers check balances, guide them through simple processes like resetting a PIN, and operate outside normal office hours. Done well, this reduces branch queues and pressure on call centers, while giving customers faster responses. Done badly, it produces robotic replies that irritate clients. The difference lies in thoughtful design, training the assistant on local languages, common questions, and polite communication styles, and always providing a way to escalate to a human agent for complex issues. For individual users, AI is entering personal finance. Budgeting and savings apps can analyze spending patterns, categorize expenses, and highlight where money leaks occur. Some tools send alerts when you overspend or suggest realistic savings targets based on income. Over time, such assistance can shift a person from living blindly from payday to payday to making informed financial decisions. Accountants and financial advisors who embrace these tools can offer clients clearer insights, combining human empathy with machine precision. On the institutional side, risk management and regulation are evolving as well. Banks must comply with anti-money laundering rules, know your customer regulations, and capital requirements. AI can support these obligations by screening transactions against sanctions lists, identifying suspicious account networks, and simulating portfolio behavior under different economic scenarios. Instead of relying solely on static reports, risk managers can interrogate dynamic models that update as new data arrives. Still, final responsibility remains with humans and boards, who must be sufficiently informed to challenge the outputs and make sound decisions. Fintech in Africa has become one of the most visible expressions of AI in finance. Mobile wallets, digital microloans, and payment platforms rely heavily on algorithms to onboard users quickly, detect fraud, and manage default risk at scale. This has enabled millions of unbanked and underbanked people to enter the formal financial system. The danger is that aggressive, opaque models may also encourage overlending, data abuse, and predatory practices. Regulators, therefore, must learn the basics of AI: what data is reasonable to collect, how models should be audited, and how to demand transparency without stifling innovation. The firm conclusion is that AI in banking and finance is neither purely a threat nor purely a miracle. It is a powerful instrument that amplifies the values and systems it is embedded in. In competent, ethical hands, it broadens access to credit, reduces fraud, improves customer service, and strengthens risk management. In careless hands, it can deepen exclusion, invade privacy, and shift power away from ordinary people. Bankers, accountants, fintech founders, regulators, and even ordinary customers must therefore reject ignorance. They must be willing to ask hard questions about how AI systems work, insist on fairness and explainability, and use these tools deliberately to build a more inclusive and resilient African financial system. Please like, subscribe, comment, and share. Thank you for listening.